Joining us now, we've got Ted Oakley, founder of Oxbow Advisors. All right, Ted, it is so good to see you this morning. All right, let's talk a little bit about your views right now on what we're seeing in terms of the market reaction to these escalating trade tensions. It seems like there is now a rising worry of not just an economic downturn, but a recession. What's your outlook?
Well, you know, Diane, what happens is I think people thought there would be people that would sort of come to the forefront and we'd work it out. Right. Yeah. But what's happening is the biggies like European Union and China are saying, no, we're not going to do that, right? Now. Yeah. So that's the problem you run into there. Then you have a really true trade war. And so if you look at companies today, public and private, they're basically saying, hey, I'm not going to order any new inventory because, number one, I don't know what's going to cost. Number two, maybe the business is going down. So that whole thing impacts things, and you throw this uncertainty. We felt like all along here this uncertainty would eventually get into the market, which it has.
Okay, so you thought that before it got into the market. What was your indication?
Well, first of all, the markets were perfectly priced. You know, we started carrying, 50% of our portfolios are in short-term treasuries, 3 and 6 month. And we started that a year ago because things were very expensive. And so by the time you got to the end of 24, they're so expensive they didn't take anything at all to break it. This really broke it, but they came from a very expensive spot. And really, they're still not terribly cheap. So I think people are not, they're kind of kidding themselves that, it just goes away.
So you think there's more downside risk from here then?
I would guess so. Yeah, I would guess so.
Yeah. Not just equities, any risk asset class basically right now. Okay. And what's your thought then? So you were moving more into short-term treasuries. We've been paying a lot of attention to the 10-year. Are you expecting to see more buying action in treasuries then?
Hard to say. I will say there's something wrong. Normally, if you look at the last 25 years, when the markets are breaking hard, the treasury market's going the other way. And so if you look at it now, though, with both of them breaking, it would tell us that there's something wrong with the bond market so big that it's not influenced by a lot of things, and it's moving on its own. So what happens on that is that you get in a situation where maybe, and I don't know really, but it looks like maybe foreign governments, small and large, are saying, you know what, I'm not certain I trust this U.S. anymore. We're going to turn those bonds. And I'm guessing, too, you've got margin calls, and hedge funds, and different things like that, and they've got to sell them.
Yeah, that makes sense. You do have a few equity picks. Let's talk a little bit about those. You've got Kimberly-Clark on your list, Colgate-Palmolive, Enterprise Products Partners, just to name a few. For Colgate-Palmolive, Kimberly-Clark, I see those look like, basically consumer staple picks. What stands out to you about, what's your thesis behind these choices?
Well, we've owned those. We've owned those for a while, too. The point is that you're always going to use those. Even if you're in a recession, you're going to use those products.
Some tissues.
Okay? Yeah. There's
some toothpaste.
Everybody every day uses a lot of Colgate and Kimberly products. But on the other side, we own two pipelines I had in there, MPLX and Enterprise Products. Right. They don't depend on the price of oil and gas, natural gas. They depend on throughput. And, we won't quit using, it may go down in price, but you won't quit using oil and natural gas. And Evergy is just it's a good utility. I mean, you got to have electricity. And so you have to look at things that are like that. Now, we own we own a lot of gold and gold and gold miners too. We've owned that for 5 years, but you have to be careful in here because once you get in, I've been through a lot of bear markets, a number of them, I will tell you. When they go down, they all go down.
This is, that's fair.
You can't really hide. That's why we have such a high degree of U.S. Treasuries.
Okay. All right, well, that makes sense then in the context, and I mean, especially then given your historical experience. I've been through a few, but not as many. So it does give you some perspective. Obviously, I know we're flirting with bear market territory, but we're already in bear market NASDAQ, Russell. We've been kind of dipping in and out of that on the S&P 500. But let's talk a little bit about, I do want to hear some insight while we have you. You wrote a book book, Rich Kids, Broke Kids. You have some thoughts on financial literacy for children. And I'm sure young people are even asking questions now. And parents in this day and age, we just got earnings from Delta, may pull back on their vacations this year, their family vacations. They may do more staycations. What's the messaging that you give to parents, especially when it comes, I'm a parent myself, when it comes to teaching financial literacy?
Well, Diane, I will tell you, the new book I've just coming out April 15th is called Second Generation Wealth.
Okay.
And it's somewhat similar to it. Rich Kids, Broke Kids is about overwhelming kids with money too early. Second Generation Wealth is about the parents and what they do with children. And I'll say this, I think people have to realize that in order to value money, you have to experience the scarcity of money. You can't value money if you never had to worry about money or anything like that. So my advice to parents, especially very wealthy, and we do a lot of business with very wealthy parents, is look, you know, you owe it to that child to have them go out on their own for 7, 8, 10 years, whatever.
So struggle a little bit?
Struggle. Because the only way you build character is through struggle. That's how you build character. And you want these kids, no matter how much money they'll get eventually, you want them to feel like I can stand on my own 2 feet, even if you didn't give me any money.
But what if you're the one who struggled already, and you know you don't necessarily want them to have that same struggle?
I'll say this to you. It's interesting you say that, Diane. I put that in the book, and I say that's basically the wrong approach. Let me tell you why. I grew up extremely poor. I mean, extremely poor, and so I understand how that feels and everything.
I understand.
But
too.
even with my own children, I think, you know, I said, look, I'm going to put you through college. I'm going to have you a car. You're not going to have any debt. But when you come out, you better have a way you're headed because you're going to be out on your own.
Okay.
And I think you have to do some tough love in order to make that work. You'll be glad in the long run, by the way, that they had to learn to pay for electricity, rent, car, whatever. And it's hard to do. And a lot of parents with a lot of money, I think it's easier for them just to give a lot of money, and that's the wrong approach, really.
Okay. All right, well, we'll have to leave our conversation there. I like the way we're finishing that. We started out with the broad market perspective, and thoughts on the bond market, all the way to finishing with what you tell the next generation. That's Ted Oakley, founder of Oxbow Advisors. Our thanks to Ted.
Hello everyone, I just want to say if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.